Today on the Purpose-Based Retirement, we're going to be talking a little bit about alternative investments. What is a private equity investment? How might you be able to actually return your overall returns in your portfolio and become a little less correlated to what we see with those big swings in the S&P 500? We're also going to talk later in the show a little bit about long-term care benefits and market valuations.
Welcome to the Purpose-Based Retirement with certified financial planner practitioner Casey Weade.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Casey leads a team of financial advisors with decades of experience, helping families across the country retire with the confidence they deserve. The Purpose-Based Retirement assigns every dollar you've saved a specific purpose to meet a key retirement need.
Whatever risk you faced, we've got a plan for that.
Stay tuned and learn how you can look forward to a worry-free, purpose-based retirement.
Good to see you again. I am Lee Kelso here with Casey Weade, certified financial planner and the president of Howard Bailey Financial. We're going to jump into the program today talking about alternative investments. Now, You're not talking about Bitcoin or something like that, right?
Right. We're not talking about Bitcoin here. We're talking about things that actually might have some real value moving forward. And these are typically, hard assets or just things that are uncorrelated to the general stock market. And yes, I guess you could say Bitcoin might be one of those alternative investments out there because it doesn't necessarily ebb and flow with the markets, and it's high risk and high potential return, and that's often what you see in the alternative investment space. What we're talking about are things that aren't your traditional stocks and bonds, right? And these are things that today really are coming in handy because we're living in a world where stock returns and market returns, when it comes to the bond market, when it comes to the stock market, those traditional investments, we're seeing that there are very few financial advisors or brokers or very experienced investment managers out there that are able to really gain an edge or gain what we call alpha on the stock market because of the availability of information out there. This is why you're seeing fees and expenses in the equity markets get really squeezed because it's not nearly as complex as it used to be, and there aren't these huge range of performances from one equity manager to another. In the alternative space, though, you don't have as much information that's available as you do in the equity markets, and now you have these opportunities out there because of the limited ability to gather this information. There are some managers out there that are really hitting some home runs. This can provide you with a place where you have the potential for higher rates of return, you have more risk, but it might just be an asset to add into the mix in a market that's projected to have very slow growth over a very long period of time or a very big correction. It's important in this type of market to stay diversified and have other places to go outside of stocks and bonds. We see stock valuations at all-time highs, getting to nosebleed levels. We see interest rates being at all-time lows. So buying a bond today might be the worst possible place you could put your money, especially in a bond fund. Interest rates rise, bond prices fall. We have to find other places to go, and an alternative investment might be that thing.
So one example of that is private equity, which has not been a place for average investors in the past.
Sure, and there's private equity is just one of those different places. It could be real estate, it could be limited partnerships, it could be hedge funds, and a lot of these places were closed off to the small investor. They were typically meant for the accredited investor over time, and that's kind of unfortunate because the returns that have been seen in these markets have been much higher than the general world stock market, and that's one of the things I want to show you, a chart that illustrates the returns in the overall world equity markets in comparison to what we see in private equity. And we can see on average it's doubling the rate of return of world equity over the last 5, 10, 15, and 20 years. So there's a huge opportunity for investors to get a piece of the pie of just a little additional returns that used to be only available to accredited investors.
What's an accredited investor?
Well, these would be individuals that have a large portion of wealth, right? And it would be someone that had over $1 million in investable assets. It'd be someone that was sitting around $200,000 to $300,000 in annual income over the last 2 years, depending on whether they're single or they're joint, or if they're married, in other words. But there's actually the ability now that we can access these types of tools tools. We can access these returns for the smaller investor, the average retail investor that's maybe got $200,000 or $300,000 saved for retirement, not $5 or $10 million, and now they can get a bite out of those returns. They can get the diversification that private equity really brings to the table. And that's a really neat thing for people, because I know the average investor that I'm sitting down with, they want to know why everybody, these big investors end up seeing these huge returns, and they don't know how to get a piece of it. Now they can.
So what's that first step? How do you determine whether or not that might be right for me?
Well, I think the first step is analyzing your overall portfolio and what your goals are. Because when we do look at private equity investments, these are typically longer term investments and illiquid investments at that. When we look at private equity, this is typically a group of maybe experienced individuals that got together, they formed a small group, and they took all of their assets and their investable assets, and they decided that they were going to go out and buy up these small struggling companies. As they went out and they picked up these small struggling firms, they would either recapitalize them or just help them get back on their feet with their expertise. They would buy a controlling ownership, and because of that control that they had over the company, they were able to make very big changes and get that company back on its feet and see huge returns. And then what they would do is they would bring in partners like you or I, and probably not you or I, but individuals that have much more wealth than we do, and then they would own a piece of the pie when it ended up going public, or they ended up taking it to a liquidation event, and that might take 7 to 10 years, and there might be no liquidity in the meantime, but with great risk comes great reward. So there's also index funds that can help us get into private equity. That might be Power Shares, for instance, has an ETF out there that allows us to start to get some exposure to those private equity returns that typically are reserved for the accredited investor. So these are just some of the tools that are out there. One of the things that we did as a firm is we partnered up with a group that the only thing they've been doing for the last decade is going out and buying up the best performing money managers in the alternative investment space. So now we have exclusive rights to have access to these individual firms that are providing these high-level services to investors that have much smaller portfolios, so we can all get a bite.
But do they still remain liquid, and is there some downside protection?
There's actually liquidity in these new tools, such as index funds and some of the funds that we use. There is actual liquidity in these, and that gives people much peace of mind. And I think that's something that the smaller investor really needs. When we're taking on a large portion of risk, I don't like tying up my money for an extended period of time in case I sense some trouble and it's time to get out. I want to stay as liquid as possible. And that's what these new alternatives in the private equity space, also in the hedge fund space, allow us to actually do. They allowed us to get that piece of the pie, get more growth potential, and get diversification, but also maintain our liquidity in the meantime, which I know gives me great peace of mind and the people that we're working with.
So if that sounds good to you, I hope that you'll be one of the next 10 people to call the number on your screen to learn more about these alternative investments as we take a look at your entire investment and retirement plan. It's a complimentary review that will take a look at what's your tax structure. Is there some efficiency that could be gained there? What kind of fees and expenses are you paying? Could we save some money there? And is there an opportunity to create a lifetime income, money that you can't outlive? All those things are things investors are looking for, so I hope you're one of the next 10 people to call the number on your screen to sit down with Casey, Marshall Johnson, or other members of the Howard Bailey team and get your own purpose-based retirement. We're back with questions from viewers in just a second.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
Welcome back to the Purpose-Based Retirement. We're here to answer questions that come to us from viewers of the program. And we're going to start today with Tim in Decatur. Tim?
In protecting my investment in my retirement, How do you do that and also help me protect growth based on inflationary issues?
Well, Tim, that's a fantastic question that I think we need to spend some time on, because a lot of people have that confusion where they go, well, I can't get more conservative as I head into retirement because I need to keep up with inflation. I have to make more than 3 or 4% per year, and I don't know that that's necessarily the reality in the first place. I mean, if we discuss inflation, most advisors take their financial planning software and they plug in the standard 3% inflation rate or 3.5% inflation rate, and then you go, oh my gosh, I'm going to go broke during my retirement. Now you're uneasy for the rest of your lives. There's been great research that's been done out there by Morningstar and other major economic research firms that have now found that the spending curve of retirees has to be factored in to how they're actually going to spend and what inflation is going to look like over their lives. And what they found is that most retirees have their go-go years, their slow-go years, and their no-go years. And depending on how much discretionary income that you have right now, it'll really be dependent on what that spending curve is going to look like over your life. But what they've found is the average retiree will see a flat spending curve after they factor in the decrease in their spending in their mid-retirement years, and then the increase in spending during their health care needs, their no-go years. What they've actually found, factoring inflation along with that, is most of those expenses actually kind of level out. And the more discretionary income that you actually have for retirement, they're going to see an even steeper, maybe even a deflationary environment for that particular retiree. We all live in our own little economies, and that's what we have to keep in mind. Not everyone's going to experience 3%, 0%, negative 2%, or 6%. Everyone is unique. But what I can also say is, even though the research has been done to show us that maybe we don't need to plan for 3% or 6% inflation, we're going to sit down with the individuals that we're working with, control what we can, play defense against the rest. And that might mean that we create a guaranteed income stream for the rest of your life. That might be a level income need for the rest of your life that we're taking care of, but we're still going to set aside a portion of that portfolio. Maybe it's 10% of the portfolio. Maybe it's 40% of the portfolio. It really is dependent on your own individual situation, and we create a concentrated inflation index portfolio with inflationary assets. That can be hard assets, that can be real estate, that can be timber, that can be in countries whose GDP, like Canada, is really tied to inflation, and that is one of the things that Australia and Canada and Sweden and those countries really do well in inflationary environments. So looking at international investments as well as hard asset investments and creating this inflation indexed portfolio where that is the purpose of those dollars. And if we see a major pullback in the energy markets or in the hard asset markets, we know that's okay because we're not experiencing inflation. We've still got our guaranteed income. But when inflation does rear its ugly head, we've got a plan for that. The purpose-based retirement's all about having a plan for each one of those major risks. Inflation is a risk, but also is longevity and also is the market. And we don't want to subject our overall portfolio to excessive market risk or longevity risk, and just because we want to outpace inflation. We play defense against those things and control the rest.
This is our email question. Mom had years of long-term care costing hundreds of thousands of dollars. As my husband and I are retiring, we want to ensure that we have protection in case it happens to us. But we're trying to decide between reimbursement coverage or cash-based policy. What do you typically recommend?
Well, Kelly, what we typically find is between reimbursement and cash-based policies, you get more of a benefit out of a reimbursement-based policy than a cash-basis policy. But the reality, and we know this is true, cash is king, right? I mean, we would prefer to have a cash policy over a reimbursement policy because that means you can spend it on whenever you might need. My uncle, my great uncle, I guess I should say, had a policy that was cash-based. And it was a life insurance policy with a death benefit that could be used for long-term care needs, or if he couldn't perform 2 out of 6 activities of daily living, it would start to accelerate that cash. Could be terminal illness as well. What happened to him was he ended up getting injured, and during that injury, he was still able to live at home, but now he had trouble transferring in and out of the shower, had trouble bathing, he also had trouble dressing. And because of those 2 things, 2 out of 6 ADLs, or activities of daily living, now portions of that life insurance policy began to accelerate to him. Now, they didn't need formal long long-term care, a licensed long-term care provider to come to the house, so they're able to use that cash in order to do a lot of the things around the house that he didn't used to be able to do. So that's where a cash policy really comes in handy. But like I said, reimbursement policies typically offer better benefits because they are typically more difficult to qualify for. And we might couple those two things together. For example, if we had $200,000, we evaluated this for a couple here recently, a $200,000 reimbursement-based policy, a hybrid long-term care policy would provide $10,000 a month, unlimited benefits, and a $300,000 death benefit if they never used it. Conversely, a $200,000 cash basis policy would provide a $400,000 death benefit and long-term care benefit, but it wouldn't be unlimited. So just evaluate all those options and maybe think about coupling them together.
Now let's get to Henry with his question about risk and return.
I'm 63 years old and not a big spender, which puts me in an unusual situation. I retired with a substantial pension, and with Social Security, I need very little income from my savings. I have everything in an IRA invested in 2.5% yield bonds. I don't want to take any risk, but it seems irresponsible to make such little interest. How can I increase my returns without taking on more risk?
Well, Henry, I'm going to actually suggest a couple of things that might be a little unorthodox, and the first of which is an investment-based. It's tax-based. You know, why not look and see if you can do some tax planning at this specific time in your life? You're 63 years old, you've got an IRA, and it's substantial dollars in this IRA. They're going to continue to grow over the next 7 years. Someday you'll be 70, and you'll be forced to begin to take required minimum distributions. Why not get ahead of the ball? Why not look into doing some Roth conversions and accelerating some of that income today rather than taking in the future? That might save you on your federal taxes, state, local taxes, and also might save you on your Social Security taxes as well in the future. And depending on the size of that IRA, maybe even save you some dollars in Medicare premiums just to do that tax planning and not even change the way you're investing. You know, it's okay to earn 2.5%. I think we get beat up a lot as investors when you say, well, I only made 4% or I only made 6%. My neighbor made 6 or he made 10%, but that's okay because maybe you only need 2.5%, and that helps you sleep well at night. Now, if you want to increase that return just a little bit, you might be able to go out and buy a fixed annuity for 5 or 10 years and get 3 or 4%. You might be able to do an indexed annuity, and now you get participation in the markets without any downside at the same time. So there are ways for you to still have principal protection and better returns than you might find in the bond market. And again, be careful of interest rate risk. Interest rates go up, bond prices go down, so you might want to look into other fixed income alternatives. But I'd say number one, let's do some tax planning because it sounds like it's time, Henry.
And the first step toward getting ready for any kind of a plan is meeting with the professional who can help you, and that's the opportunity we have for you today. For the next 10 people who call the number on the screen, Casey and his team at Howard Bailey will sit with you and review your financial and your retirement plans, helping you create a purpose-based retirement custom to you. So please be one of the next 10 callers to call the number on your screen to get on the calendar with Casey or members of the Howard Bailey team to sit down and receive your very own purpose-based retirement. All right, our question of the day, it's an important one, has to do with the S&P 500. How much has it returned in total since its 2007 peak? Casey has the answer when we come back.
Let me help you create the retirement you dream of. Go to my website and pick one of 3 education options to get started today. Get a copy of one of my retirement planning books, sign up for a purpose-based retirement live event, or go to the Purpose-Based Retirement University. 2 days of college-level retirement planning instruction. With the right education and proper coaching, I believe anyone can create the retirement they dream of. It all begins with one step. Visit thepurposebasedretirement.com.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
Just before the break, we asked you our question of the day. It had to do with performance of the S&P 500. Casey, which one of these is correct?
Well, Lee, we find ourselves in one of the longest bull markets in history, and people want to know, well, how did we get ourselves here? And what is that real return? Well, the answer is actually B. 60% is what the S&P 500 has returned in total since the 2007 peak. The interesting thing about this is that you would typically think that that would track gross domestic product or economy's growth. It would also probably track sales growth. However, it's grown 3 times the growth that we've seen in corporate sales growth. It's also finding ourselves 30% more in growth in gross domestic product. Why is that? Well, it's been fueled by the $4.5 trillion expansion in the Fed's balance sheet. It's been fueled by the zero interest rate policy that we've also had here in the U.S. And now we're starting to see valuations of a stock market that are getting incredibly overblown by another thing that we're going to talk about here in just a minute, which is billions of dollars in share buybacks. And I'm not the only one that's questioning the valuation of the market. You're not the only one concerned that the market's getting to such peaks that sooner or later it must have to have a major pullback in order to at least normalize or revert to the mean. We can look at several major names in economics and in the markets today, one being John Bogle. That would be the leader of Vanguard, the founder of Vanguard, CEO of Vanguard here today, really the founder of buy and hold investing, which is beginning to question how much cash you should be actually holding in your portfolio. Warren Buffett, the Oracle of Omaha, and Robert Shiller and James Tobin, both professors of economics at Harvard and Yale, and also both winning the Nobel Prize as well in economic areas. So one of the things we want to take a look at first is we want to look at what the growth of the S&P 500 has looked like in comparison to what we've seen in corporate earnings growth as well as gross domestic product. And we can see this red line here shows us that cumulative S&P 500 growth is greatly outpacing what we're seeing in cumulative GDP growth or sales growth for that matter. So we're seeing what we've seen Robert Shiller call irrational exuberance. And if we look at not just Robert Shiller, we also take a look at John Bogle's measure. If we look at the measure that he created for his valuation of the market, we can see that this puts us in one of the most expensive markets in history, markets we have only seen this high since over the last 15 to 20 years through the 99s and the 2007 peak. And it's not just John Bogle, but it's also James Tobin and Robert Shiller, which you can see here. We've graphed both lines. We've graphed Robert Shiller's valuation measure, and we've also graphed the Q ratio. That's James Tobin's valuation measure, both winning Nobel Prizes, and Robert Shiller for winning a Nobel Prize for his valuation of the market and projecting forward returns of the market. And now that you can see this, you can find that we're in the second or third most expensive market throughout history based on these different valuation measures. Now, what about the Oracle of Omaha? What does Warren Buffett have to say about current market valuations? Well, there's a reason that Warren Buffett is now holding record levels of cash in his portfolio, and that's because it's getting very difficult to find good value buys out there today. If we look at his valuation measure, it puts us in the second most expensive market in history, second to the 1999 peak, of which we all know we saw a major pullback over the following 3 years. Now, why is this? Why are we continuing to see the market go to higher and higher heights, and we're not actually seeing earnings growth get all that much better? Well, if we look at the major talking heads, if we look at CNBC, they'll say, well, growth in the stock market and the S&P 500 is being supported and fueled by earnings. Well, if we look at one of those things that's actually going on called share buybacks are really what's boosting earnings. It's not that these companies actually have increased sales growth. We've seen this dramatic drop off in the number of outstanding shares, that red line there on your screen, and that helps to continue to boost earnings. However, even though we've seen continued share buybacks in the billions, we're seeing that that's starting to have less and less impact on the overall stock market. This is how that works. If we take a look at a balance sheet of your average S&P 500 company, we would take a look at a company that has cash balances. We're going to use some nice round numbers here so you can understand how share buybacks really work. A cash balance before the buyback of $20 million, assets of $50 million, earnings of $2 million, and shares outstanding of 10 million. Now, we have a return on assets of 4% per year. That's $2 million over our $50 million in assets. That means we have earnings per share of 20 cents per share outstanding. Now, what if that company uses a portion of their cash, $15 million in cash, to go out and buy up some outstanding shares? Now they've reduced their balance sheet, their assets, to $35 million, not changing their earnings. They've reduced their shares outstanding, and that's boosted their earnings, so the return on assets when it comes to looking at their balance sheet, to 5.71%. But in reality, we haven't actually seen any increase in sales growth over that period of time. This is why I want you to exercise caution in the market that we're in today. I want you to start to think, hey, what happens if we have the next 2008? What happens if we have the next 1929 to 1932 or the next 1987 Black Monday? Are you going to panic? And I'm not saying that this is going to happen tomorrow, but what I am saying is you better have a plan, because it will happen at some point in the future. And this means that you need to be working with someone that's putting a plan together that doesn't just plan for the best and hope for the best, but plans for the worst and also hopes for the best as well. And that's one of the things that we do at Howard Bailey Financial is we look at the worst case scenario. We want to outline where those biggest risks are to your retirement and begin to put a plan together for that in the future. And today we feel that the market does pose a significant concern to retirees that either can't afford the loss because they don't have the time to make up the loss before they get to retirement, or they need income from these assets that they've saved and they can't afford to stop taking income while the market's down. We have to have a plan for the worst case scenario.
Yeah, and we've had a stock market that's had over 55 new highs this year alone. So you've got to imagine that there is going to be that big pullback coming, and that is frightening to retirees.
And that can be a huge opportunity as long as we're not fully invested in the stock market at all times. This is why I hold a significant portion of cash. This is why I encourage the people that we work with to hold a significant portion of cash, and not just real cash, but also put it someplace that's liquid. I've got a significant portion of my portfolio someplace that's totally liquid. I can get back at any time, but if the market goes up 20%, I make 10. So at least I know that I'm not just going to sit there and watch the market continue to rise and feel like I'm missing out time and time again, because many people, we just can't afford to go without a return. You know, that's another thing that we have to keep in mind. I had a couple I worked with the other day that said, you know, I don't mind staying fully invested because I've got 5 years before I retire. They said, we've got time to make up a loss. Well, the reality is we could go 5 years with not making up a loss, but even more importantly, without a return, even if we made up those losses, and they couldn't afford to have that whole portfolio go without any returns for 5 years. And there's ways that we can structure that portfolio that still gives us upside potential, but protects us if we don't see that actually come to fruition. You have to have a plan that guards you against the worst.
I hope that's one of the reasons that you're going to be among the next 10 callers to phone the number on your screen right now and get on the calendar for a complimentary review of your financial and retirement plans, taking a look at exactly what is your tax structure. Are you paying more than you maybe should? What types of fees and expenses are built into your portfolio today that could be affecting how well you'll do? And then is there a way to guarantee a lifetime income that you can't outlive? Those are all factors of the purpose-based retirement and reasons I hope you're one of the next 10 people to call the number on your screen and get on the calendar for Casey, Marshall, and the other members of the Howard Bailey team so that they can give you your very own purpose-based retirement. And we hope that you'll take advantage of another opportunity we have for you, and that is to contact us at info@howardbailey.com or visit thepurposebasedretirement.com. We'll see you next week.